Today, we're taking a hard look at a financial showdown unfolding in 2025. One that could reshape not just banking, but the very rules of global trade. It began with an ultimatum. In early 2025, the U.S. Treasury issued one of its most aggressive warnings in years. Any bank caught facilitating Iran-linked oil trades, especially those routed through China and processed in alternative currencies like the yuan, risk being cut off from the dollar system entirely. That's not just a sanction, it's a financial death sentence. And the ripple effects are already shaking the world economy. Let's break this down step by step. 1. The ultimatum that shook global banks. In April and May of 2025, Washington targeted foreign banks with an iron fist, focusing particularly on Hong Kong institutions. The Treasury's message was simple. If you move Iranian crude, especially in yuan-based deals, you will lose access to the U.S. financial system. That effectively drafted international banks into serving as enforcers of U.S. sanctions. And within weeks, Washington proved it wasn't bluffing. 9 Hong Kong-linked firms were sanctioned for laundering oil money through fake shipping paperwork. The U.S. didn't just sanction the trades, it demanded transparency at every level, ordering banks like HSBC and Bank of China, Hong Kong, to reveal the ultimate beneficial owners behind shell networks. These shell companies are the engines of yuan-based oil transactions, and the U.S. is now trying to dismantle them. By the first quarter of 2025, more than 54% of Hong Kong's $260 billion in cross-border settlements were in yuan, not dollars. That set off alarms in Washington, which saw this shift not only as sanction evasion, but as a strategic threat to the dollar's global supremacy. The result? A deepening financial divide, where the dollar's dominance is openly contested by a parallel system fueled by the yuan. But Iran's strategy doesn't rely solely on bank settlements. Its hidden financial engine runs much deeper. To Iran's hidden financial engine, smuggling, shells, and sanctions evasion. Iran has spent decades perfecting sanctions evasion. And by 2025, its methods are more advanced than ever. On June 6th, the U.S. sanctioned more than 30 individuals and companies, led by the Sering Halim brothers, accused of laundering billions through front firms in Hong Kong, the UAE, and beyond. How does this work? Tankers carrying Iranian crude frequently switch names, flags, and tracking systems mid-voyage. Some disguise shipments as Malaysian blend or other false identities. The oil is then sold using fake manifests, with payments routed through layers of shell firms and informal money networks. The revenue doesn't just fund the Iranian economy, it directly fuels the IRGC, drone development, and proxy militias. Iran even uses barter trade, exchanging oil for gold, steel, or industrial equipment. The U.S. Treasury and FinCEN have now issued red flag advisories warning banks to look for mismatched cargo data, suspicious paperwork, and trade patterns that make no economic sense. In short, Washington is no longer targeting Iran's oil. It's targeting the entire shadow financial architecture that props up its sanctions-proof economy. But while Washington tightens the screws, another player is accelerating its own strategy. China. 3 China's yuan strategy, building a system without the dollar. As the U.S. cracks down, Beijing is speeding up its long-term mission, breaking free of dollar dominance. By March 2025, the yuan accounted for 4.13% of global payment volume, briefly ranking as the world's 4th most used currency. It dipped slightly in April, but the trend is unmistakable. China is laying the foundation for a non-dollar world. The backbone of this strategy is CIPS, China's answer to the SWIFT system. With 170 direct participants and nearly 1,500 indirect ones across 119 countries, it is already the default channel for yuan-based settlements. At the same time, Beijing is pushing state-owned giants to settle trade directly in yuan. UnionPay's QR code system now dominates digital payments across Southeast Asia, allowing transactions to bypass the greenback entirely. And then comes the digital yuan, or ECNY. Quietly, it's spreading through bilateral trade deals from Pakistan to Laos, ensuring that when the next sanction storm hits, China has rails of its own to run on. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way. For Beijing, this isn't just about currency. It's about building a financial firewall against U.S. overreach. But Washington's aggressive enforcement is now creating turbulence at home, too. 4. Economic whiplash when U.S. sanctions hit home. While the U.S. tries to police global finance, its own economy is showing signs of strain. By April 2025, consumer sentiment plunged to near-record lows. Inflation expectations hit 5.6%, levels not seen since the 1980s. Retail and wholesale profit margins fell 1.6%, while manufacturing job growth flatlined and real wages slipped 0.3% quarter-on-quarter. Congress then passed a massive tax relief bill, but tucked inside was a clause raising withholding tax on foreign companies from 10% to 12.5%. Economists warn this could slash foreign direct investment into the U.S. by as much as $91 billion annually. Add to that unpredictable tariffs, Chinese imports swinging between 10% and 30%, and businesses face paralysis. Investment freezes, supply chain delays, and policy unpredictability are all becoming hallmarks of the American economy. In trying to defend dollar dominance abroad, Washington risks destabilizing its economy at home. 5 cracks in the system. The dollar's shaky future. The bigger picture is clear. The dollar's dominance is no longer absolute. Sanctions, smuggling networks, yen alternatives, and domestic turbulence are pushing the world toward a more multipolar financial system. Regional blocks, swap lines, and central bank digital currencies are gaining traction. On July 30th, 2025, the U.S. unveiled its biggest Iran sanctions package since 2018, freezing assets tied to Mohammed Hossein Shamkhani's oil empire, 52 tankers, 15 firms, and a dozen individuals. But instead of isolating Iran, moves like this may accelerate the global shift away from dollar reliance. Confidence in the dollar is eroding. More countries are experimenting with yuan-based payment systems and CBDCs to hedge against U.S. control. This isn't the collapse of the dollar, but it's the beginning of a slow drift toward a multipolar monetary order, where the U.S. no longer drives every lane of global finance. Verdict: the dollar's gamble in overdrive. In 2025, Washington raised the stakes. It tried to isolate Iran, pressure China, and protect the dollar's role as the world's reserve currency. But in doing so, it may have unintentionally laid the blueprint for a fragmented system where no single currency dominates. China's yuan, digital payment systems, and regional alliances are already pulling trade away from the dollar highway. And sanctions fatigue is pushing countries to design alternatives. The big question now, if the dollar isn't behind the wheel of global finance, who takes control and under what rules? So what do you think? Did the U.S. overplay its hand with this aggressive strategy? Can the yuan, or any other currency, really challenge the dollar's supremacy? And how will these shifts affect global trade and energy flows in the years to come? If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way.